Today I'm wearing my Chilliwack Chiefs hoodie right here. Yesterday they tied up the Series 2-2 in the PCHL, so that's one note outside the financial sector for today. Uh, Work from this week, I reviewed a small US bank. This one was interesting to me. In the banking sector, you'll find the big banks so frequently are priced to perfection. Hard to find good value given they're so monitored and efficient. If you're looking for value in the banking space, often a mid-sized to small cap bank is where you'll find mispricing, which is one reason I took a look at that sector this week. This bank, Third Coast Bank Shares, I don't own any shares in this bank, should clarify, nor do they pay me, although that would be nice. But just reviewing some research and everything stated today is just my own opinion, not financial advice. Starting with some notes generally on the banking space. When it comes to small and big banks often trade at a premium to small banks given their safety and their diversified business platform compared to small banks, which enables price discovery and misvaluation in the smaller bank space. When it comes to in the interest rate environment, conversely, the big banks, small banks often benefit from rate cuts, given their deposit base is less sticky than the big banks. They often have to provide a higher return to retain deposits, which actually takes me to my first point on the slide. Let's take a look here. Net interest margin, we'll find 2025 over 4%, which is highly competitive as far as the banking space of this size, increasing from 2024. Which suggests for this community bank there's a low cost deposit base or a high yield niche in their Texas lending market. Moving on to the asset yield, we'll find asset yield increasing from 2021 to 7.76, down from 8.12, indicating potentially that the bank is starting to shift towards a higher credit quality client. However, the 7.76 in 2025 confirms that their business model is sensitive to a rising rate environment. I did want to note in the 2021 when rates were lower, if we go back to interest margin, they actually had a higher interest margin, meaning which suggests in lower rate environments they actually have a higher differential, kind of going back to my first point about what they have to pay on deposits versus what they earn on loans is actually higher when rates are lower. That could be what my figures here confirm. Moving on, which that differs from big banks in that sense. Moving on to financial leverage, we'll see an explosion in their total asset base, more than doubling since 2021, all the while their leverage staying roughly level, suggesting that as they increase assets, in lockstep they increase their equity, which we'd like to see. That suggests high quality risk management and potentially avoiding the need for regulatory scrutiny going forward. On the risk side, we kind of like to see that. Moving on to return on assets in 2025, breaking the 1% standard, which is considered competitive in the community banking space. And the steady climb in return on assets shows the bank is becoming more profitable per dollar of assets. On this channel, we like to review companies based on fundamental factors, not momentum, not multiples, not macro data, the flavor of the month. We look at how the business is actually doing and how it's expanding, return on assets, profitability margins, sales growth, R&D spending, things like that. We like to take a focus on fundamental factors, what's happening there, and we find long-term, or I find long-term, that's what generates growth and reliability. Moving on to return on equity decomposed for banks using return on assets, which I just covered, and the leverage ratio covered before. Multiply those two together, we get roughly the return on equity rising each year from 2021 to 2025, at 12%, just over in 2025. We see this return on equity largely comes from an increase in return on assets, which we like to see compared to coming from leverage staying roughly level, return on assets more than doubling, which suggests a high quality form of growth, not just taking on more risk for the sake of generating higher returns. And the 1.2% return on assets combined with their leverage has a powerful compounding effect. If the market takes notice, it could be recognized as being rewarded in their stock price. Lastly, the valuation method I used for this company, and it's the valuation method I'm going to use when it comes to banks. Usually I use the free cash flow to equity method. When it came to this bank, I used what's called the residual income method, given their book value was so significant, and that's generally the case when it comes to certain companies in certain sectors, banks being one of them, financial companies being one of them. The residual income is actually a more reliable method than using their free cash flow for a number of reasons. But if you look at their book value, price to book value, for this bank, it's hovering around 1.2-ish price to book value, which is low, meaning their book value represents a large portion of the value of the company, rendering a residual income discounted cash flow method suitable for valuing this company, more or less. When you take my sensitivity grid here, we'll see discount rates on the vertical axis, terminal growth rates on the top bar, 1 to 6%. Based on a CAPM, capital asset pricing model formula, I determined the discount rate for this company should be around 8.5%. If we take that to be the required rate of return for this company, we take their book value and their residual income, which I calculated from the 2025 income, we will get roughly an intrinsic value in the range of, we consider a growth rate long term of 2 to 3%, somewhere between 45 and 58%, $58. This is US dollars. Disclosure, I used book value and net income from 2025. If I were to average out net income from 2025 and 2024, that would bring down the intrinsic value, given the net income was lower in 2024, to closer to $40, which means somewhere in the range of $40 to $58, let's say. You'll find the intrinsic value lies somewhere in there. Depends on how conservative you want to be. I just went with the 2025 figures, given significant changes in the company, in particular their asset base growing so much over the course of the last 5 years. I felt it disingenuous to just average the last 5 years net income and book value, and to determine a value based on the average, given how much the company has changed. As an analogy, consider taking an athlete who is 20 years old and using their performance from 5 years prior as indicative of who they are today. It might not be relevant. So I took 2025 figures. If it's an outlier, I'm disclosing that now, but I felt that was the best indication of future performance given the trajectory that they're on as far as their asset growth. Okay, that settles my ratios. I'm going to move on to Lastly, I have recommendations. So I put this as a buy. We're gonna place this as a somewhere between a hold and a buy. I'm gonna say in the bull case we have on the high end $58 as an intrinsic value. Base case somewhere between 45 to 47. I'm gonna say 40 to 47, somewhere in there. It's a base case, which I feel is justified, assuming the bank continues their margin expansion while maintaining their return on equity above 12%. Some further pointers: net interest margin strength is competitive among peer banks, and this is driven largely by a highly sensitive loan portfolio for their deposits. Return on equity trending from 5% to 12%, is consistently crossing their cost of capital threshold. So some profitability measures there that I think are strong. And then lastly, the book value, price to book value of this company being around 1.2x. It says 1.2% there. That should say 1.2x of their book value. Suggests that they have a bit of a floor in terms of their valuation. Their stock price, their market cap is largely backed by what they actually have in equity, for the most part, which is to me that's an attractive entry point. That's a sign of safety. That so much of the value currently priced by the market is represented by what they have as book value. So that's all for today as far as this company. It's a small bank, one you may not have heard of. I'll try to cover more content covering companies that are maybe outside the regular lists and workflows that you may have seen. Lastly, if you like this content, please like and subscribe and leave any comments in the comment section. Thank you.